Okay, let's unpack this. Welcome back to the Deep Dive.
Great to be here.
Today we're taking a huge amount of information, decades of financial research, and really distilling it down.
That's the goal, making it structured, making it actionable, specifically for you, the ambitious learner out there.
And our focus, growth, stock investing, the core mechanics. But we're looking at it through a pretty unique lens.
Yeah, the investor's dojo. We're kind of framing it like martial arts progression, starting with the white belt, working our way up.
But this isn't about, hot tips or gut feelings.
Absolutely not. This is all grounded in the rigorous, fact-based system developed by William J. O'Neill, the founder of Investors Business Daily, a legend.
So the mission is pretty ambitious, really, giving you a kind of shortcut to understanding market mastery.
Or at least a clearer path. We're taking historical research, and this is amazing. It goes back to 1880.
Wow, 1880.
Yeah, and looking at what the biggest winning stocks had in common before they made those huge runs.
It's about identifying patterns from history.
Exactly, patterns based on facts.
Now, we should acknowledge, investing can feel, daunting for a lot of people. Foreign, maybe overwhelming.
For sure. People think you need a finance degree or some secret knowledge, but what this research really shows emphatically is that success is achievable.
If, and it's a big if.
Right. If you can remove emotion and follow a proven strategy, a strategy built on, like we said, historical facts, not opinions.
And that martial arts metaphor,
Right.
The dojo, the belts, the training, it helps structure that discipline, doesn't it?
It really does. It reminds you that success in the market needs discipline, it needs a routine, and crucially, it needs a strong defense, just like martial arts.
Okay, ready to learn the stance, the strategy.
Let's step into the dojo.
So first step, just deciding to enter the dojo. What actually gets people started? What's the motivation?
It's usually something concrete, something real, not just a vague idea of getting rich.
Like a life change, or maybe hitting a pain point.
Exactly. The sources give us some really relatable examples. It's often driven by necessity or a desire to fix something that's broken.
Like Mike Scott's story.
Yeah.
He got laid off, right?
Yeah.
The fence industry cuts in California.
Yeah. And suddenly his goal wasn't some far-off dream. It was immediate. He needed to replace that lost income for his family, that kind of urgency. It lights a fire under you.
Or think about the defensive side. People seeing their savings dwindle.
Oh, absolutely. That's maybe even more common. You have Carol Chanter. She saw her husband's 401k just getting hammered during a market correction. She needed to stop the bleeding.
And Gay Walsh, similar story. IRA accounts going down, needed a real strategy for retirement security.
That feeling of loss or potential loss, it's powerful. It makes you seek out answers.
We also see people aiming for bigger life changes, financial independence.
Right. Anindo Majumdar. He wanted out of the corporate grind, wanted more time with his family. That's a huge motivator.
And Townsend Baldwin,
Yeah.
wiped out in the dot-com crash. That kind of financial trauma really forces you to reevaluate.
It does. These stories all point to the same thing. The journey really starts when staying put becomes more painful than making a change.
Just making that decision, deciding to seek out a better way.
Right.
That's the first hurdle.
It really is. And, the source material says you should congratulate yourself just for taking that step. Most people don't. They just stay stuck.
But here's the interesting paradox, isn't it? The biggest roadblock isn't necessarily lack of knowledge or the market being too complex.
That's exactly what O'Neill found. The number one obstacle is internal. It's your own doubts, your own procrastination, that fear of trying.
He said you're missing out on one of the greatest chances to change your life if you let that fear stop you.
Pretty powerful statement.
So, okay, say someone does try. Why do most individuals still end up losing money? The stats aren't great.
Simple answer, no strategy, no discipline. They're flying blind, driven by emotion.
Chasing tips from their brother-in-law.
Right. Or they buy a stock because, I like their coffee or I use their phone. They completely ignore the actual financial health of the company.
And the big one, bargain hunting. Buying stocks just because the price has collapsed.
Oh, that's a killer. They think they're getting a deal because a stock dropped 50 or 70%.
But usually there's a reason it dropped.
Exactly. These are often former leaders that are fundamentally broken or being dumped by institutions. Buying them isn't savvy. It's like trying to catch a falling knife. You're betting on resuscitation, not on strength.
Okay, but let's flip that. The individual investor, the one who does embrace a strategy, they actually have a key advantage over the big Wall Street funds, right?
A massive advantage. Agility. Speed.
How so?
Think about it. A huge mutual fund manager might need weeks or months to build or unwind a large position in a stock without moving the price too much against them. They're like battleships.
Hard to turn quickly.
Very. But you, the individual investor, you're like a speedboat. You can see a signal buy or sell and act instantly. Get in, get out decisively.
Yeah.
That nimbleness is your superpower if you use it right.
And using it right means having a framework, a system.
Which brings us to CanSlim. That's the foundation of the dojo training. It's the proven strategy, built from studying those historical winners before they took off.
It's the set of rules, the fact-based method focusing on those 7 key traits of winning stocks.
That's the playbook.
All right, so we've decided to invest. We've entered the dojo. Now comes the white belt stage. What's the absolute first principle?
Market timing. Understanding the overall market direction. It's less about what you buy sometimes and more about when.
The old saying, a rising tide lifts all boats.
Pretty much. The first rule, the non-negotiable rule, is market direction is everything.
Why is that so fundamental?
Because the historical data is crystal clear. 3 out of 4 stocks, maybe even more, basically follow the general market trend.
So trying to pick winners when the whole market is tanking is
Swimming against the tide. It's incredibly difficult and usually financially painful. Even the best stock can get dragged down in a severe correction.
So you have to wait. Wait for the market to signal it's safe to get back in the water.
Precisely. Which leads us to the most important signal in this whole system for determining when that shift happens.
The signal that a downtrend or correction might be ending and a new uptrend is beginning.
Yes. It's called the follow-through day, often abbreviated FTD.
Okay, let's break this down carefully. This sounds critical for anyone learning the system. What exactly defines a follow-through day?
It's got 3 specific parts. First, you need to see one of the major market indexes, the S&P 500, the NASDAQ, maybe the Dow, start to rally off its recent low point. Just a few days of upward movement, a little bounce.
So the market stops going down and tries to lift its head a bit.
Right, that's the initial rally attempt. Second, you need the quantitative trigger, the real sign of conviction.
The actual price move.
Yes. On the 4th day of that rally attempt, or any day after that, day 4, day 5, day 6, day 7 are pretty common, but it can be later. One of those major indexes has to close up strongly for the day. The threshold is usually 1.5% or more.
A solid gain. Not just barely positive.
Exactly. Needs some power behind it. But price alone isn't the whole story. There's a third piece, arguably the most crucial.
And that is
volume. Trading volume.
The confirmation.
Absolutely. That big up day, that 1.5% or more gain, must happen on trading volume that is significantly higher than the volume of the previous day.
Why is that volume spike so important? What does it tell us?
It signals that the big players, the institutions, are coming back into the market, professional money. They control most of the capital, and when they start buying aggressively, you see that surge in volume. It validates the rally.
So a big price jump on weak volume could just be noise.
Could be a sucker's rally, yeah. A technical bounce without real commitment. That high volume is the footprint of institutional accumulation. They're shifting from defense to offense.
Okay, now the sources are clear that this signal isn't foolproof, right? Not every follow-through day works.
That's a critical point. Sometimes the market gives an FTD signal and then it rolls over a few days or weeks later and goes back into correction. FTDs can fail.
So why rely on it if it sometimes fails?
Because the historical research is absolutely unequivocal on this, while not all FTDs lead to successful uptrends, no major new market uptrend in history has ever started without a follow-through day.
Wow, okay. So it's a necessary condition, even if not always sufficient.
Exactly. It's the best odds-on signal we have that the trend might be changing in your favor. If you jump in before an FTD, you're essentially betting against the prevailing trend. You're guessing.
So let's say you get a confirmed FTD. Price up 1.5% plus volume higher than yesterday on day 4 or later of a rally attempt. What's the immediate action plan?
You need to be ready before it happens. Two things. First, during the correction, you should have been building and refining your watch list, identifying top-quality growth stocks, setting up potential buy points.
You can't start searching after the signal.
No time. Second, once the FTD is confirmed, you start carefully putting capital to work. You begin buying the best stocks on your list, the true leaders, ideally as they break out of sound consolidation patterns or bases, right around the time of the FTD.
Like Randall Morrow did. He saw the FTD in December 2011 and knew it was time to shift from cash back into leading stocks.
That's the discipline. And it doesn't stop there. Even after an uptrend is confirmed, you need to stay in sync daily.
How do successful investors do that?
They use tools. They check reliable sources like the big picture column in IBD every day to see the official market pulse status, confirmed uptrend, correction, whatever it is. They watch daily market rep videos to understand the action in leading stocks.
It's not about gut feel. It's about monitoring the evidence.
Absolutely. The white belt lesson is humility. Respect the trend. Wait for the market's green light the FTD before you commit serious capital. Let the market tell you when it's time.
Okay, we know when to consider buying only in a confirmed uptrend after a follow-through day. Now, the dojo training phase is about what to buy and exactly when to pull the trigger on an individual stock.
This is where the CanSlim methodology really comes into play, those 7 characteristics of winning stocks. But just finding a stock with great fundamentals isn't enough. The timing of your entry is crucial.
So we need to talk about chart patterns first. The technical setup.
Yes. Specifically, buying stocks as they break out from areas of price consolidation known as bases.
Why is buying at the breakout point so important? Why not buy earlier when it's maybe lower in the base?
Because history shows that's the point of least resistance. Inside the base, the stock is chopping around, going sideways, correcting. It could stay there for weeks or months. You tie up capital and patience.
And buying after it's already run up significantly from the base.
That's buying extended. Very risky. It's prone to sharp pullbacks that can knock you out for a loss right before the real move starts. The breakout from a sound base offers the most optimal entry point, balancing risk and reward.
And this breakout needs a specific trigger, doesn't it? It's not just any move above the base.
It's very specific. Volume again. The breakout day's trading volume must be at least 40% higher than the average daily volume over, say, the last 50 days.
40% or more. That's a significant jump.
It is. That surge in volume is the footprint of the institutions. It tells you that the big money is moving in forcefully, all at once, providing the power needed to push the stock into new high ground. Without that volume confirmation, the breakout is suspect.
So for someone learning to read charts, what should these bases or consolidation patterns look like? What are the common ones?
The most classic and often most reliable is the cup with handle pattern.
Okay, visualize that for us.
Imagine a teacup in profile. The cup part is a period where the stock price corrects, usually dropping maybe 15% and 30% or so over several weeks or months, forms a rounded bottom, and then climbs back up towards its previous high point. It looks like a U-shape.
Got it. And the handle?
The handle is a shorter, typically 1 to 4 week period of slight downward drift or sideways action that forms on the right side of the cup near the top. It should generally stay within the upper half of the entire base structure.
What's happening psychologically during the handle?
It's like a final little shakeout. It lets the last few weak holders sell out before the stock makes its big move. The proper buy point is when the stock price breaks above the high point of that handle area.
And crucial.
On that massive volume surge. At least 40% above average. Handle shouldn't droop too low either. If it corrects more than, say, 10-15% from its peak, it's often flawed.
Okay, cup with handle. What's another key pattern?
The double bottom base. It looks like the letter W.
Describe the W shape in stock terms.
The stock price drops to a low, first bottom, rallies up partway, middle peak of the W, then drops again to a second low. Here's the subtle but critical part. That second low should ideally undercut the first low by a small amount.
Undercut. Why is that important?
It's another shakeout mechanism. It triggers stop-loss orders for people who bought near the first low, washes out bearish sentiment, and sets a trap just before the real move starts. The buy point is when the stock price decisively breaks above the middle peak of the W.
Again, on high volume.
Always on high volume for the breakout confirmation.
And buying extended far above these breakout points is dangerous because a quick pullback could hit your stop loss.
Exactly. You get stopped out for a loss, maybe 7-8%, just because you chased it too high. Patience for the right entry is key.
Now, there's another layer to this base analysis, base stage counting. Why does it matter if a stock is breaking out of its first base versus, say, its fourth or fifth?
This is a really valuable insight from O'Neill's research. The studies clearly show that breakouts from earlier stage bases, the first or second proper base formed after a stock begins a major uptrend, tend to be much more successful and lead to bigger gains than breakouts from later stage bases.
Like third, fourth, fifth bases.
Yeah.
They become riskier.
Significantly riskier. Think about it. By the time a stock is forming its fourth or fifth base, it's usually had a huge run already. It's well known. The institutions that got in early, back at the first or second base, are sitting on massive profits.
Then they might be looking to sell.
Exactly. Later stage bases are often where those early institutions start to distribute their shares, locking in gains. So those breakouts are much more prone to failing quickly because of that overhead supply from profit takers. You want to get involved earlier in the cycle.
Okay, so that covers the when and the where on the chart. Let's get back to the CAN SLIM fundamentals, the engine driving the stock.
Right. The 7 letters. CANSLIM.
Let's quickly recap. C is current earnings. What's the benchmark?
You want to see big increases, ideally double or triple-digit percentage growth in earnings per share, EPS, in the most recent quarter compared to the same quarter a year ago. The higher, the better. Mediocre earnings won't cut it.
A is annual earnings growth, looking for a strong multi-year track record.
Yes. Shows consistency. You want to see significant annual earnings growth over the past few years, maybe 25% or more, and look for accelerating growth if possible. We also need strong sales growth, at least 25% in the recent quarter, often much higher in the true leaders, need that top-line growth too.
And as for new, this seems really important for finding explosive growth.
Crucial. New products, new services, new management, new industry conditions, or the stock hitting new highs in price. Something new has to be driving the story.
Like Whole Foods tapping into the organic movement? Or Green Mountain with the Keurig?
Perfect examples. That newness often creates huge untapped markets and fuels those monster stock runs. And a stock hitting new price highs isn't bearish, it's bullish. It shows strength and demand overcoming supply.
Okay, S is supply and demand. How does that work?
It looks at the number of shares available to trade, the float. Generally, stocks with smaller floats can move up faster on good news because there's less supply to absorb the buying demand. But more importantly, it ties into...
I for institutional sponsorship.
Yeah.
The big money.
Yes. You need institutions buying the stock, preferably an increasing number of high-quality institutions, like top-performing mutual funds, taking positions. That volume surge on the breakout. That's the institutions voting with their dollars. If they're not involved, the stock likely won't make a major move.
L is leader or laggard. This one trips people up, doesn't it? Buying the best, not the cheapest.
It's counterintuitive for many. You want to buy the stocks that are already leading their industry group and the overall market in terms of price performance, not the ones lagging behind that look cheap.
How do you measure leadership?
The relative price strength, RPS rating, is key. It compares a stock's price performance to all other stocks over the past year. You generally want stocks with an RPS rating of 80 or higher, meaning it's already outperforming 80% of the market.
So avoid the temptation to buy the beaten-down value stock in a hot sector.
Avoid it like the plague. Leaders lead for a reason, usually superior fundamentals, better execution. Laggards lag for a reason. Buy strength, not weakness.
And finally, M is market direction. Back to the white belt lesson.
It all comes back to M. Are we in a confirmed uptrend based on that follow-through day signal? If not, even a stock that looks perfect on the other 6 letters is too risky to buy. M is the gatekeeper.
Wow. Okay.
Yeah.
That's a lot to check. It sounds like it could take hours every day.
It sounds like it, but experienced practitioners streamline it. People like Ted Leplat taught a simple daily routine, maybe 30 minutes.
What's the routine?
1, check the market trend first. The big picture column. Uptrend. Correction. 2, scan lists of top-rated stocks, like the IBD 50 or other screens using CAN SLIM criteria. Maybe add 1 new potential name to your watch list. 3, use online tools like Stock Checkup on investors.com to quickly verify the key CASLI metrics. 4, look at the chart. Does it have a proper base? Is it near a buy point?
So it becomes a focused, repeatable process.
Exactly. Discipline replaces complexity.
All right, we've covered entering the dojo, the basic stance of market timing, and the core training of stock selection. Now comes belt promotion. This is about putting it all together in actual trades.
Yeah, this is where the rubber meets the road. It's not about hitting 1 home run. It's about applying the rules consistently, trade after trade, and learning from each one. Sharpening your skills, just like advancing through belt ranks in martial arts.
And the learning process isn't always solitary, is it? The sources talk about the value of community.
Hugely valuable.
Wow.
The IBD Meetup Groups that sprang up are a great example. Think of them as local dojos where investors could gather.
What happened in these meetups?
People would discuss the market trend, share potential stocks for their watch lists, review chart patterns together. It creates accountability, and crucially, you learn from watching others, especially more experienced investors.
Like Gay Walsh found, attending multiple groups helped her get it.
Right. She specifically said watching other people read charts was really helpful for her visualization. It clicks differently sometimes when you see someone else apply the rules.
And it wasn't just physical meetups. People used online resources too.
Absolutely. Katrina Gunsch, the lawyer, used online webinars from groups like the Chicago IBD Meetup. Didn't matter where she was, she could tap into that shared knowledge and analysis. It accelerates the learning curve significantly compared to just reading a book alone.
Let's look at some specific examples from the sources. How do these principles translate into actual success stories? Kevin Dye's story highlights the timing aspect, right?
Perfectly. Kevin really took off once he internalized the importance of the follow-through day. He started focusing intently on high-quality stocks that were breaking out right around the time an FTD occurred.
Because those are often the leaders of the new rally.
Often, yes. That strict adherence to timing, combined with solid stock selection, led him to a 580% cumulative return over 5 years. It shows the power of syncing your buying with the market signal. White belt plus dojo training.
Jason Diamore's Lululemon trade is interesting. It combines specific chart pattern with some real-world observation.
Yeah, he initially bought Lululemon on a breakout from a 3 weeks tight pattern. That's a less common but very powerful pattern.
What does 3 weeks tight mean again?
It's when a stock closes 3 consecutive weeks basically unchanged, less than a 1% price change from Friday, close to Friday, close for 3 weeks straight. It shows incredible stability and absorption of any selling pressure, often right before a big move.
But he didn't just rely on the chart, did he?
No, and this is a great point about the N factor. He actually went into a Lululemon store. He saw the product quality, the customer enthusiasm. That real-world check gave him conviction.
Conviction to hold on during inevitable volatility.
Exactly. When you have that fundamental belief based on observation, you're less likely to get shaken out by normal pullbacks.
Brian Gonzalez's experience with Dollar Tree shows a different kind of success, knowing when to take a smaller profit.
Right. He bought it correctly as it bounced off a short-term moving average showing support. He got a decent 12% gain quickly.
But he sold it.
He sold it because the overall market started showing signs of weakness, potentially heading into a correction. This is key. Sometimes the market environment changes and you have to protect your gains, even if they aren't the 20-25% home run you hoped for. Discipline means adapting to the market.
And Randall Morrow's Whole Foods trade is a classic example of identifying leadership during weakness.
A perfect case study. The general market was struggling, correcting, but Randall noticed Whole Foods was bucking the trend. It was showing relative strength. While the indexes were weak, Whole Foods was actually making higher price highs. It was acting stronger than the market.
What does that signal?
It signals that institutions are likely accumulating shares despite the market weakness. They see something special there. It flags the stock as a potential leader for the next uptrend whenever it begins.
So when did he buy?
He waited for the confirmation. He bought it on January 17th, 2012, when it broke out of a proper cup with handle base.
And the volume?
This seals it. Volume on that breakout day was 149% above average. Massive confirmation. That's institutions piling in.
So each of these victories, big or small, reinforces the rules and builds the skill. That's the belt promotion.
Exactly. One successful rule-based trade at a time.
Okay, if finding and buying winners is the offense, this next stage, kicking the bag, is all about defense. And the sources stress this is arguably more important.
Absolutely paramount. You can find great stocks, time your entries perfectly, but if you don't know how to protect your capital, 1 or 2 bad trades can wipe out months or years of gains. Defense wins championships in sports and in the market.
There's that great quote from the Taekwondo master Hong Hai Choi.
Pain is the best instructor, but no one wants to go to his class. It's so true for investing. Learning to take small losses is painful initially, but it's essential for survival.
And Jesse Livermore, the legendary trader.
His advice is timeless. Take your losses and don't brood about them. Keep them small, move on. The goal isn't to avoid losses entirely. That's impossible. The goal is to avoid catastrophic losses.
Which brings us to maybe the single most important rule in the entire system, the iron rule for cutting losses.
This is the non-negotiable bedrock rule of capital preservation.
What is it?
You never, under any circumstances, allow a stock to fall more than 7% to 8% below your purchase price. Full stop.
7 to 8%, that seems really tight.
It is tight, and it has to be. If a stock hits that 8% loss level, you sell it immediately. No questions asked, no hoping it will come back, no second guessing. Emotion out, rule in.
Explain the math behind why such a small loss limit is so critical.
The math is brutal if you let losses run. Let a stock drop 25%. You need a 33% gain just to get back to even. Let it drop 50%. You need a 100% gain You have to double your remaining money just to break even. It's incredibly hard to recover from big losses.
But if you stick to 7-8%,
A single decent winner, say a 20% or 25% gain, can erase the sting of 2 or 3 of those small losses. It keeps your capital intact, and importantly, it keeps you psychologically in the game. You haven't blown up your account.
Kevin Martin learned that the hard way with Microsoft, right? Held on past the rule, down 20%.
Yeah, and he realized violating that rule meant he wasn't investing anymore. He was just hoping, speculating. That 7-8% rule forces discipline.
And the beauty of it is that it takes a moment-to-moment anxiety out of it if you commit to it.
Totally. You predefine your exit point before you even buy the stock. Brian Gonzalez and Jason Diamore talked about this early on. They'd watch every tick, get nervous.
So what do they do?
They started setting automatic stop-loss orders with their broker, maybe even tighter, like 4-5% below their entry. If the trade didn't work right away, bang, they were out with a tiny loss. No agonizing, no emotional decision needed in the heat of the moment.
As Brian said, the rules keep you grounded. Remove the fear.
But there's an opposite danger, isn't there? Especially after you've had some success.
Ah, yes. The danger of falling in love with your stock.
This is maybe the most common way experienced investors blow themselves up. You have a huge winner, it's made you a lot of money, and you become emotionally attached. You start ignoring sell signals because, well, it's been so good to you.
Kathleen Phillips's story is heartbreaking. Building that dream portfolio in the 90s, Cisco, Intel, Microsoft.
She thought they'd go up forever. She got attached. And when the bear market hit after the dot-com bubble burst, she couldn't bring herself to sell.
Watched huge gains just evaporate.
A massive portion. All because the attachment blinded her to the clear sell signals, the market trend changing, the stocks breaking down technically. She had the offense, but zero defense.
And Lee Tanner with JDS Uniphase. A 3,700% gain.
Incredible gain. But he admitted he got sloppy and lazy on the sell rules after it had that massive run up a climax top.
Gave most of it back.
Most of it. Imagine the psychological pain of that. Seeing life-changing money disappear because you didn't follow the defensive rules. These stories are why the 7-8% rule is ironclad.
Okay, so that's defense on the downside. What about taking profits? How do you when to sell a winner? You don't want to sell too early, but you don't want to ride it all the way down either.
There's a rule for that too, based on historical tendencies. It's the 20-25% profit rule.
How does that work?
As a general guideline, the system suggests taking profits on most stocks when they are up 20% to 25% from your proper breakout buy point.
Why that specific range?
Because the market studies show that after a 20-25% advance from a base, many stocks will pause, pull back, and consolidate again, maybe form another base. Or sometimes that's where they peak. Locking in that solid gain is a prudent way to manage risk and ensure you capture profits.
But what about those monster stocks? The ones that go up hundreds of percent. Don't you miss out.
There's a crucial exception to the 20-25% rule. It's designed to keep you in those potential monster winners.
What's the exception?
If a stock surges 20% very quickly specifically, within just 2 to 3 weeks of its breakout that signals exceptional strength, it might be one of the true market leaders.
So if it hits 20% that fast, you don't sell.
Correct. The rule then says you must hold that stock for at least 8 weeks from the breakout point. This forces you to sit through inevitable minor pullbacks and gives the potential big winner room to run. It helps filter the truly powerful stocks from the ordinary ones.
8-week hold rule for rapid gainers. Got it. Now, besides the 7-8% loss rule, are there other signs that tell you it's time to sell a stock, even if it hasn't hit your profit target or loss limit? Signs the stock might be topping out.
Yes, definitely. These are called distribution signals. Signs that the institutions, the smart money, are quietly selling their shares while the public is still optimistic.
What should we look for? What are the red flags?
There are about 6 key warning signs.
Okay, number 1.
Greatest weekly price spread. The range between the high and low price for the week becomes wider than any previous week during the stock's entire advance. Huge volatility often happens at tops as buyers and sellers battle it out. High volume break of the 50-day moving average. That 50-day line is a key institutional benchmark. A decisive close below it, especially on heavy volume, is a major warning sign that support is failing. Largest daily price run-up. This sounds counterintuitive, but often the single biggest up day in a stock's entire run happens very close to the final peak. It's called a climax run, a final burst of euphoric buying before the exhaustion sets in.
4.
Heaviest daily volume. The day the stock actually peaks often occurs on the highest trading volume seen during the entire advance. Especially dangerous if it's a reversal day, opens high, closes low on huge volume.
5.
Repeated high-volume selling days without progress. You see multiple days where volume is very high, but the stock price churns and makes little or no upward progress. This is classic distribution institutions are unloading shares into the remaining buyers.
And 6.
Increase in consecutive down days, the rhythm changes. Instead of mostly up days, you start seeing more clusters of down days, maybe 4 or 5 days down for only 2 or 3 up. The upward momentum is clearly fading.
Seeing one or more of these signals should make you very cautious, potentially prompting a sale even before the 8% loss roll is hit.
Exactly. They are the market's way of whispering, get out now. Anindo Majumdar used these principles respecting market direction and sell signals to successfully take profits and buy a house. Defense secures the gains.
We've covered timing, selection, offense, defense. This final stage, sparring with the opponent, feels like the ultimate challenge. And the opponent isn't the market.
No. The opponent is you, your own ego, your emotions, fear, greed, hope, arrogance. The market finds every single one of your psychological weaknesses and exploits them. Mastering yourself is the black belt level of investing.
The story of Aloha Mike is a stark warning here. He had success using the system.
Yeah, several years of disciplined gains following Can Slim, but that success went to his head. He got arrogant, started thinking he knew better than the rules.
What did he do?
He started ignoring the 7-8% sell rule. He was so sure I knew what I was doing, as he put it. He let losses run way past 8%. Disaster, he took losses of 25%, even 40%, wiped out years of hard-won profits in just a few trades because his ego wouldn't let him admit he was wrong and cut the loss small.
It's a common trap, isn't it? Especially for people successful in other fields. Doctors, lawyers, business owners.
Very common. They think because they're smart or successful elsewhere, they'll naturally be good at the market. But as Bill O'Neill famously said, the market doesn't care about your IQ or your job title. It doesn't care at all. The rules apply equally to everyone. Humility is essential.
So how do the really successful traders manage this? How do they keep their ego in check and trade without emotion?
They develop specific tactics, mental and practical strategies to maintain discipline, almost like a fighter training their mind before a match.
Mike Scott, the guy who got laid off, had some interesting techniques. He stopped looking at the short-term noise.
Exactly. He made a rule for himself. Stop watching the 5-minute intraday charts. All that flickering and noise just provokes emotional reactions, constant second-guessing.
So what did he focus on instead?
He made the weekly chart his primary tool for decision-making. It smooths out the daily noise, shows the bigger, more important trend. It helps you stay patient and avoid impulsive moves based on transient volatility.
He also used physical breaks, right?
Yeah, if he felt tempted to break a rule, he'd literally get up and walk away, go for a walk, ride his bike. Physical distance to create mental distance. He even practiced Zen meditation to cultivate focus and calmness. It's about managing your state.
Aloha Mike, after his costly mistakes, developed a mental framework too. The 3 roads.
Right. He constantly reminded himself that any stock can only do one of 3 things. Go up, go down, or go sideways. Accepting all 3 possibilities kept him mentally flexible, prevented him from getting fixated on just one outcome, usually the one he hoped for.
Ultimately, it seems to boil down to treating investing with extreme seriousness, like a business.
That's the key insight many successful traders arrive at. Paramjit Chumber realized he had to treat it like a business, with a formal plan, even monthly performance reviews. It's not a hobby, it's a high-stakes profession, even if you do it part-time.
Steve Power detailed a really rigorous weekend routine that exemplifies this business-like approach.
Yeah, it's very structured. First, create a watch list, maybe 10 to 30 top stocks meeting the Can Slim criteria. Then refine that down to a buy list, maybe 1 to 5 stocks that are actually setting up near proper buy points.
And critically, he managed his existing positions systematically.
Every week, where you'd update stops on a spreadsheet, recalculating that 7-8% sell price for every single stock he owned. Non-negotiable.
You kept a journal.
A market journal. Recording trades, thoughts, reasons for buying or selling. This feeds into the most crucial part of continuous improvement, post-analysis.
Analyzing your trades after the fact. Why is that so vital?
Because you absolutely have to learn from your mistakes and your successes. Katrina Gensch would print out the daily and weekly charts whenever she bought or sold a stock, creating a visual diary.
And then review them. What questions would she ask?
The hard questions. Did I follow all my rules on this trade? Was the entry point correct? Was the volume right? Did fear or greed cause me to sell too early or too late?
The goal isn't to beat yourself up, but to identify patterns in your own behavior.
Precisely. Identify your specific weaknesses. Maybe you consistently chase extended stocks. Maybe you hesitate on the sell rule. Deborah Clute called her losing trades valuable learning experiences. That analysis helps you formulate personal rules to counteract your specific tendencies.
So this constant sparring with your own ego, the rigorous routine, the honest self-assessment, that's the path to mastery.
It is. As Jahandar Kakvan put it, if you take the precautions, follow the simple, strict rules, you can succeed. But it demands that ongoing, sometimes painful analysis of where you personally need to improve. #outro.
So we've journeyed through the Investor's Dojo today, from the initial decision to the final internal battle.
It's been quite a deep dive. We started with the decision why people even step onto the mat, often driven by pain or necessity, and realizing the biggest hurdle is often self-doubt.
Then we earned the white belt by mastering market timing, understanding that you absolutely must wait for a confirmed uptrend signaled by that crucial follow-through day. Don't fight the market tide.
Dojo training taught us the can-slim offense, how to identify fundamentally strong leaders, CANSLI, and pinpoint the low-risk entry, the breakout from an early stage base, like a cup with handle, on massive volume.
Belt promotion came from applying those rules, learning from successes like spotting relative strength or using tight patterns, and understanding the value of community and adapting to market shifts.
Then came the crucial defense, kicking the bag. That non-negotiable 7-8% loss rule to protect capital and the 20-25% rule for taking profits, with the key exception for fast gainers, learning the warning signs of distribution.
And finally, the highest level, sparring with the ego. Recognizing that controlling your own emotions, biases, and arrogance through routines, weekly chart focus, and rigorous post-analysis is the ultimate key to consistent success.
The big picture, as William O'Neill always emphasized, is that opportunity is always out there. Every market cycle brings new innovations, new leading companies, the next potential Google or Apple. You just need the system and the discipline to find them and manage the trades correctly.
And it doesn't necessarily require being glued to a screen 12 hours a day, does it?
Not at all. David Ryan, one of O'Neill's star pupils, famously said that success can come from just half an hour of focused study each day. Finding just one or two great stocks in a year, managed properly with the rules, can lead to outstanding results.
Before we wrap up, there's that little interesting humanizing detail about Bill O'Neill himself in the source material, about his watch.
Right. Apparently, he often wears a Mickey Mouse watch. And sometimes, after giving a speech or presentation where he borrowed someone else's fancy watch, he'd forget and walk off still wearing it.
Which leads us to a final thought for you, the listener, to ponder.
If Bill O'Neill, arguably one of the most disciplined, data-driven, rational minds in modern investing history, could be completely absent-minded about something as fundamental as time in his personal life, what does that tell us?
What does it tell us about the intense focus and rational presence required when we are looking at those market charts? Charts where price and volume are plotted against time, where every tick matters, and where a single moment of emotional distraction, a flicker of ego, can be the difference between a disciplined trade and a costly mistake.
Maybe it tells us that mastery isn't about being perfect in all things, but about applying absolute discipline precisely where it counts the most, countering our inherent human weaknesses when our capital is on the line. We're embarking on really a journey toward mastery.
Right.
Think about the pursuit of excellence in any field chess, music, martial arts, It always requires discipline, adopting a proven system, and just, years of relentless practice.
Absolutely.
Today, we're applying that exact roadmap to the world of investing. We're aiming to move you from, let's say, the novice white belt stage right up to the strategic grandmaster level.
That's a great analogy.
Yeah.
And, we've compiled a massive, truly invaluable stack of sources here.
Yeah.
It's a collection of success stories, some really painful lessons too, and the core philosophies from, the most accomplished individual and professional investors who follow the system, pioneered by the legendary William J. O'Neill.
Okay, so our mission for you today is pretty straightforward. We are distilling decades of this high-level market experience.
Cutting through the noise.
Exactly. Cutting through the noise, extracting the actionable, specific knowledge you need to master the market like a true professional. This deep dive is essentially your shortcut. Understanding not just what to buy, but really when to buy, when to sell.
And big one.
And most critically, how to manage the psychology. That's what separates the winners from the burnouts.
It really is. So we've structured this deep dive to follow that progression of mastery.
Makes sense.
We begin with white belt and dojo training.
Yeah.
Establishing those non-negotiable fundamentals.
Okay.
Then we tackle breaking boards, focusing on the crucial defensive tactics, the profit-taking rules.
Right, the practical application.
Exactly. Next, we face black belt testing. This is where we address the internal struggle, the discipline required.
The mental game?
The mental game, precisely. And finally, we synthesize the highest level insights from Grandmaster Bill O'Neill himself.
Okay, let's unpack this journey then. Start with the foundation, the white belt training.
Right.
Because if you misjudge this first step, every single decision you make after that becomes exponentially riskier, doesn't it?
It absolutely does. And that critical first step is definitively determining market direction.
Market direction, okay.
This cannot be overstated. O'Neill's core research, it established that roughly 3 out of 4 stocks, that's 75%, they just follow the general market trend.
75%, wow.
Yeah. So this means if the overall market is in a confirmed correction or, a bear market, even the best stock pick, the one with explosive earnings, it can and likely will fail.
So you're just fighting the current.
You're swimming against the tide, and it's just a guaranteed exhaustion of capital.
Right.
Therefore, the absolute first rule of the system is you must restrict your buying to an officially recognized uptrending market, period.
Okay, but how does an investor know? How do you know when the market has finally shifted from that, treacherous correction back into a new, maybe safer uptrend?
Emotions cloud judgment.
They absolutely do.
So we need a hard, repeatable signal.
Exactly. And this is where the follow-through day, or FTD, becomes the essential entry ticket.
The FTD. Okay, explain that. The FTD is basically the market's way of signaling that institutional money is finally moving back off the sidelines.
Ah, the big money.
The big money. And it's moving into leading stocks. So when the market's been in a correction, first we need to see a few days of maybe a weak rally, just trying to find a bottom.
Okay.
Then the follow-through day happens.
Right.
Typically, it's between day 4 and day 7 of that rally attempt.
Right.
And it's when one of the major indexes, usually the NASDAQ or the S&P 500, closes at least 1.5% higher than the previous day.
1.5% gain, but there's a critical technical component too, right? To prove it's not just a fleeting bounce.
Yes, absolutely crucial. It's the volume.
Volume.
That 1.5% advance must occur on trading volume that is clearly noticeably greater than the previous day's volume.
Okay.
This volume component is the confirmation. It shows professional institutions are committing significant capital.
So it's not just like retail hope.
Exactly. It's not just hope. It's the big fish actually moving the boat.
Okay, I think we need to emphasize the historical weight of this rule, though, because sometimes the FTD fails, right? It doesn't always work.
That's a fair challenge, yeah.
So why rely on it so heavily?
Some FTDs do fail, absolutely. But here is the overwhelming historical truth, and this is key. No major, sustained, new uptrend in history.
None
Has ever begun without one of these confirmed follow-through days first taking place.
Wow. Okay.
It's a necessary condition, even if it's not always sufficient on its own, for market safety.
Right.
It is that moment the odds shift from, say, 75% against you to at least 50-50. It gives you the green light to start carefully deploying capital again.
And investors track this how? Practically.
They monitor it almost religiously using resources like the big picture columns market pulse section. It simply states the market status, confirmed uptrend, correction attempt, or downtrend.
Takes the opinion out.
Exactly. Removes personal opinion from that critical directional decision.
Okay, so the market gives us the green light with an FTD. Now we can focus on the offense.
Right.
The core strategy for finding those future market giants. The system known universally as CAN-SLIM.
CAN-SLIM. It's the distillation of O'Neill's, half-century of research. It identifies the 7 common, really powerful traits shared by nearly every stock that delivered those massive gains before those gains were obvious to everyone.
Okay.
Right now, in our, let's say, dojo training phase, we really focus on the fundamental traits, the ones that prove a company is truly accelerating its business and generating superior profit.
Let's break down those essential fundamentals then. The triumvirate, C, A, and S.
Okay, C stands for current earnings. We're looking for aggressive, really explosive quarterly earnings per share EPS growth.
How much growth?
Ideally double or even triple digits. The higher the better, really.
Yeah.
We want to see a major palpable acceleration in profitability compared to the same quarter last year.
Okay. C is current earnings. What about A?
A is for annual earnings and return on equity, ROE. This looks more at the track record.
The longer view.
Exactly. A minimum of 25% annual earnings growth over the last 3 to 5 years. But the real insight here, I think, is the ROE return on equity.
Ah, ROE.
We look for at least 17% ROE. Though honestly, the truly great leaders often sport much, much higher numbers.
Why is that ROE number so important? It feels like it gets overlooked sometimes compared to the headline earnings growth.
It does, but it's a measure of efficiency. It tells you how effectively the company is turning shareholders' money into new profit.
Okay.
A high ROE, say 17% plus, proves management is allocating capital brilliantly. They're not wasting money on unproductive assets or, bad acquisitions.
So it's a quality sign.
It's a key sign of a quality, aggressive growth company. And finally, S is for sales.
Sales. Right.
Profitability can sometimes be, let's say managed or massaged quarter to quarter.
Sure, accounting tricks.
Right. But sales are harder to fake.
Huh.
So we require a minimum 25% increase in sales in the most recent quarter compared to the same quarter last year.
25% growth there too.
Yes. If earnings are accelerating alongside sales, then you have pretty solid proof of a booming business model.
Okay, makes sense. So we found these fundamentally sound leaders using C, A, and S. Now we move into the dojo training application. Buying at the breakout. Why can't I just buy a stock that meets all the can slim criteria whenever I feel like it? Why the timing?
Because timing, as they say, is everything in the market, or at least a lot.
Right.
You can have a brilliant stock, meets all the criteria, but if you buy it when it's already extended in price from a proper base.
Extended. Meaning it's run up too far already.
Exactly. It's already had a significant move up from its last consolidation area.
Right.
If you buy it then, you expose yourself to an unnecessary, almost inevitable 10% to 20% pullback.
Ouch.
Yeah. Market history just shows again and again that all major winning stocks pause. They consolidate, they form these chart bases before making their next significant upward move.
So the base is like the rest period. And the breakout is the launch pad. Define that moment, that point of maximum opportunity.
Okay, the precise buying point, or the breakout, is defined when the stock successfully pushes above the resistance line of its consolidation pattern. The ceiling, if you will.
Okay.
But here's the key again. This must occur on trading volume that is at least 40% higher than average.
40% volume increase. That's specific.
Very specific. That massive volume surge is the institutional endorsement. It's the professional money signaling, okay, we believe this move is real, we're putting our weight behind it.
And what are the specific shapes, the consolidation patterns that investors are taught to look for?
We teach 3 core patterns. The most common is probably the cup with handle.
Like a teacup.
Visually, yes, it resembles a teacup. The handle part is a very brief, usually gentle consolidation phase right before the actual breakout. It's like a final tightening.
Okay, cup with handle. What else?
Second, we look for the double bottom. This looks like a W shape on the chart.
A W.
But crucially, the low point on the right side of the W must slightly undercut the low point of the left side.
Undercut it. Why?
It's a classic technical move designed to shake out the last remaining weak-handed investors. Scares them into selling right before the real move starts.
Sneaky. Okay, double bottom. And the third.
Third, the tightest and often the most explosive pattern is the 3 weeks tight, sometimes called 3WT.
The 3 weeks tight.
This is where the stock's closing price fluctuates less than 1% for 3 consecutive weeks. It shows extremely tight institutional control and accumulation, like a coiled spring.
Wow, okay. Cup with handle, double bottom, 3 weeks tight. But the sources also emphasize it's not just what the base looks like, but where it occurs in the stock's overall climb. Let's talk about base stages.
Yes, this is a critical nuance. It's one of those things that really separates the amateur from the skilled practitioner.
How so?
Stocks form a series of bases as they advance over time. Think of it like climbing stairs. Each base is a landing. There's a first stage phase, then maybe a second stage, a third, and so on.
Right.
The rule is you must target breakouts from first or second stage bases.
Only the early ones.
Primarily, yes. By the time a stock is breaking out of a fourth or fifth stage base, it's generally too late. too risky.
Why is that later stage so risky? I mean, if the fundamentals are still excellent, why worry?
It's because of the institutional money flow. By the fourth or fifth stage, the stock is already, well, too obvious.
Yep.
Everyone sees it.
Okay.
The institutional investors, the big mutual funds, the hedge funds, who got in during the first or second stage base, they've already amassed huge profits.
Right. They're sitting pretty.
Exactly.
Yeah.
And now they're actively looking for liquidity, meaning lots of buyers, so they can start selling and locking in those profits.
Ah, so the late buyers provide the exit for the early winners.
Precisely. A breakout from a fifth stage base is highly likely to fail quickly because the earlier big money holders are ready to distribute, to sell their shares to the enthusiastic new buyers coming in late.
Got it.
The history of leadership stocks, like Netflix, for example, shows they typically form a maximum of 4 or 5 successful bases before the major run ends. And, a much longer consolidation or even a decline begins. You must buy early in the cycle.
That makes perfect sense. You want to ride the wave with the institutions, not be the person they're selling to at the crest.
Exactly.
Okay, so given all this necessary scrutiny, you've got the market trend, the slim fundamentals, the chart-based pattern, and the base stage. How do successful individuals actually manage this? It sounds intense. How do they fit this into a manageable, simple daily routine?
It sounds like a lot, but the routine is essential for mastery. And it proves you don't need to be glued to a screen all day long.
Right.
We look at models like Ken Chin and Ted Leplatt. These were highly successful professionals in other fields, dentistry, IT.
Busy people.
Very busy people who applied discipline. Their routine breaks down this complex analysis into simple, repeatable steps. Takes the overwhelm out of it.
Okay, walk us through those practical steps. What does a routine look like?
Okay, first thing every day, check the big picture to know the market pulse. What's the current trend?
Trend first. Always.
Always. And maybe start a watch list of any stocks mentioned there that are up on unusual volume. Second, they utilize the time saver table on investors.com.
Time saver table.
Yeah, it's a quick summary of the highest ranked stocks by composite rating. It helps focus your attention immediately on maybe 1 or 2 new high-quality candidates. Saves time.
Got it. Third,
they use the stock checkup tool. This gives an instantaneous snapshot of the stock's key fundamentals, earnings, sales, and crucially, its industry group strength. Is it in a leading sector?
quick fundamental check.
Right. And finally, only then, after all that, do they actually consult the chart.
Only at the end.
Only at the end, to see if that potential leader is currently setting up in one of those proper first or second stage base patterns.
So it's a filtering process.
Exactly. Trend, top stocks, quick fundamentals, then chart check. This whole process can take minutes, not hours. We heard about Bharani Ramamurthy, an IT professional.
Right, the coffee break trader.
Yeah. He managed to use his short coffee break to check stocks on the move, quickly scanning for that institutional buying activity. That's what alerted him to successful stocks, like Tractor Supply.
Wow.
This routine turns analysis from, overwhelming guesswork into something mechanical, efficient, and sustainable.
Okay, so we've moved past the theory, the dojo training. Now we're into the practical application. This section is called breaking boards.
Right.
Because it involves the successful execution of the strategy, actually making those winning trades, but also, crucially, the necessary defense, the sell rules.
Yes, the defense is key.
And when we talk about execution, we always have to come back to the power of institutional buying, right? That means volume.
Volume, volume, volume. It's the fingerprint of institutional intent.
Yeah.
We mentioned earlier that volume confirms the breakout.
Right, the 40% rule.
Exactly. But it's also the constant gauge of the stock's health throughout its run. Institutional money, we're talking mutual funds, sovereign wealth funds, hedge funds. That is the only force powerful enough to drive a stock's price significantly higher over weeks and months.
Retail money just doesn't cut it long term.
It simply doesn't move the needle in the same way, not for those big sustained advances.
So if volume is the clue to institutional money, how can you, the listener, track where the big fish are putting their capital? In real time, even.
Well, a key practical tool is the Stocks on the Move feature, available on investors.com, for example. Successful investors check this tool throughout the day, not just at the close.
Throughout the day.
Yeah, just quick glances. To identify leaders rising on unusual volume as it's happening, this gives you an immediate objective alert that institutional support might be entering, or sometimes leaving, a stock.
And Bharani Ramamurthy, the IT pro, used this.
He used this exact routine during his coffee break. It alerted him to Tractor Supply, TSEO. He quickly confirmed its top fundamentals, noticed it was breaking out of a tight pattern, a 3 weeks tight.
Ah, one of the patterns.
Exactly. He bought the stock and, crucially, followed his sell rules, locking in a solid 20% return.
Nice.
It just shows how small, efficient bursts of data checking focused on volume can lead to significant gains.
Let's shift gears a bit to the N in CAN SLIM. That stands for new products, new services, or new highs.
Right, the new.
This feels like where the successful investor connects the dots, right? Connects the technical data on the chart with what's actually happening in the real world, like being a detective.
That's a perfect way to put it. The biggest winners, almost invariably, are companies that are fundamentally changing their industry or tapping into some massive cultural shift. They offer something new.
And that requires more than just screen time.
Absolutely. It requires engaging with the real world. Looking around, we have some fantastic anecdotes from the sources illustrating this proactive approach.
Yeah, tell us those stories, the real-world observations.
Okay, take Pat Reardon. He started noticing Skechers shoes were just everywhere.
Seeing them on people's feet.
Exactly. He saw moms and kids all over his hometown wearing them. This real-world observation prompted him to actually go check the stock's ratings.
Yeah.
When he confirmed the company had top earnings growth and a solid chart set up, he knew the trend he was seeing wasn't just local, it was real.
Yeah.
That led him to a successful 20% trade.
Simple observation leading to profit.
Okay. Similarly, Lee Tanner with Crocs. He didn't just trust the chart.
What did he do?
He actually went to a local Macy's department store, and he observed the dedicated, prominent display section they had just for Crocs.
Ah, physical retail presence.
Yeah, seeing that high visibility and dedicated retail space confirmed the consumer adoption trend for him. That confirmation gave him conviction, which later led to a massive 140% gain in the stock.
Wow, 140%. And Randall Marr's insight on Whole Foods Market, that was about spotting a broader societal new, wasn't it?
Exactly. Morrow recognized that the shift toward organic food wasn't just a fad. He saw it as a massive secular trend, a new way consumers were choosing to live and eat.
A long-term shift.
Right. He connected this macro trend to the specific stock's excellent CAN SLIM fundamentals. And that allowed him to hold the stock through inevitable market volatility.
Because his conviction was stronger.
Exactly. His conviction was based on that long-term societal shift, not just a wiggle on a short-term stock chart.
Okay, the N also heavily applies to the IPO opportunity, initial public offerings.
Oh, definitely. New public companies are often the definition of new. They're frequently introducing revolutionary products or business models. Mike Scott learned this lesson the hard way, actually. He completely missed the Google IPO breakout.
Ouch. Missed Google.
Yeah, because he hadn't fully grasped the concept of buying a high-quality IPO as it breaks out of its very first base. That first consolidation after going public.
So he learned from that.
He did. When Michael Kors came along later, he didn't repeat the mistake. He saw the signs. Quality underwriters, explosive triple-digit earnings and sales growth right out of the gate, and the product's visible popularity.
And the timing.
He bought Kors on a powerful gap-up breakout from his first IPO base, which is often the safest and most explosive time to buy a quality IPO. And he realized a significant 74% gain.
74%. Not bad.
Not bad at all. Quality IPOs hitting those CAN SLIM marks early are often the gold standard of new.
Okay, now we have to move to what might be the most difficult yet absolutely the most essential element of this whole system.
The defense.
The essential defense. Cut losses, lock in gains. This is the defensive strategy. It protects your capital. It really defines whether you achieve long-term mastery or just churn your account.
This is the golden rule, and it is completely non-negotiable. You must keep all losses small and just move on.
No exceptions.
No exceptions. The predetermined mandatory stop loss is 7% to 8% below your original purchase price. Full stop.
7 to 8%.
That's your insurance policy. If a stock falls 8% from where you bought it, you sell. No questions asked. No hoping it comes back. You sell because the trade has proven you wrong.
Why that specific number, 7% to 8%? Is there a mathematical reason?
There is. It's purely a function of recovery math. A small loss only requires an equally small gain to recover.
Okay.
For example, 7% loss requires only about a 7.5% subsequent gain to get back to even. Manageable.
Right.
However, if you let that loss balloon to, say, 25%, you now need a 33% gain just to break even.
Much harder.
Much harder. And if you let it hit 50%, you need a 100% gain where you have to double your remaining capital just to recover what you lost.
Wow. Impossible odds almost.
Almost. By strictly adhering to the 7-8% rule, you ensure that no single mistake, no single bad trade can ever blow up your account.
And people struggle with this emotionally.
Immensely. Brian Gonzalez and Jason Diamore both admitted they only successfully conquered the emotional difficulty of cutting losses when they started setting automated sell triggers with their brokers.
Automating it.
Yeah, often setting them even tighter, maybe at 4% or 5% below the buy point.
Yeah.
It just removes their own judgment, their hope, their fear from the process entirely. The machine executes the rule.
Takes the emotion out. Okay, so small losses are managed quickly and ruthlessly. What about the winners? What's the corresponding profit rule?
Okay, the system dictates you should sell most of your winning stocks for a solid 20% to 25% gain.
20 to 25%. That might sound counterintuitive to some people, right? Aren't we looking for the 100% home run?
That's the dream. But O'Neill's historical research shows very clearly that the vast majority of winning stocks pull back sharply, or they enter months-long consolidations right after that initial 20-25% surge from the breakout point.
So you take the gain and run?
You take that solid gain, redeploy the capital into a new leader that's just setting up in a proper first-stage base. That's the optimal strategy for compounding returns over time. It's about consistency, not home runs every time.
But what if I have a stock that's just soaring? If I cut it at 25%, don't I risk missing that potential 100% run? How do you get comfortable taking profits relatively early?
That is the core psychological struggle of every single investor. And it is where the discipline, that black belt mindset, really kicks in.
Right.
You have to remember, you are not betting your entire future on a single trade. You are managing a portfolio, a business, over months and years, potentially decades.
It's a marathon, not a sprint.
Exactly. Lee Tanner learned this painful lesson at an advanced workshop. He watched portfolio simulations that proved, statistically, that taking consistent 20-25% gains was superior over the long run to holding on and hoping for monsters every time.
So you might miss some big ones.
You might miss some monster moves, yes, but you will avoid far, far more devastating pullbacks from stocks that peak around that 25% mark and then roll over hard.
Okay, risk management again. But there is an exception, right? For the truly explosive stocks, the potential monster winners.
Yes, there is a specific exception, and it's a sign of true institutional power behind the stock.
What is it?
If a stock goes up 20% in just 2 to 3 weeks from its breakout point.
That fast. 20% in under 3 weeks.
Yes, that kind of rapid acceleration. If that happens, you hold it for a full 8 weeks, minimum.
8 weeks? Why 8 weeks?
Because a stock that surges that rapidly often indicates such overwhelming institutional demand that it likely has the fuel to run much further. The 8-week hold rule gives that potential giant the room it needs to make a truly significant move. It's your chance to capture a real outlier game.
Okay, so 20-25% game is the rule. Unless it happens super fast, then hold for 8 weeks.
Got it.
That's the essence of it.
Now, we mentioned the cost of failure to sell. The sources are just full of these really cautionary tales.
Oh, they are heartbreaking. They're stories of greed or sometimes just affection for a stock, completely overriding discipline.
Like Kathleen Phillips.
Yeah, Kathleen Phillips. She built this massive portfolio of tech titans in the 90s. Cisco, Intel, the big names then.
Right. But she admitted she fell in love with their stocks. Couldn't part with them. She ignored clear market warnings, the distribution signals.
And then the bubble burst.
And then the tech bubble burst, and the subsequent bear market wiped out a huge portion of her hard-earned gains. All because she couldn't bring herself to sell her winners when the rules said she should.
Oof. And Lee Tanner with JDS Uniphase?
An even more extreme example. He was up an astronomical 3,700% in JDS Uniphase by early 2000.
3,700%. Incredible.
Incredible.
What?
But he admitted he became sloppy and lazy on the sell rules. He got complacent. He sat right through the final climactic top formation.
Did sell.
Didn't sell.
Yeah.
And watched that unbelievable paper gain just erode dramatically in the crash that followed.
Yeah.
The market does not care how much money you have made in a stock. It will take it right back if you ignore the sell signals. Discipline is paramount.
Okay. Beyond the hard 7-8% stop loss, what are the more subtle advanced selling signals? The technical topping patterns that basically scream that institutional money is quietly, or maybe not so quietly, distributing its shares, selling out.
Right. These are specific warnings. They often relate to sudden, unusual increases in volume or volatility. They signal a shift in the supply-demand balance.
Okay, but like what?
First, watch for the greatest weekly price spread. if the range between the high price and the low price in a single week is wider than any previous week during the entire upward run.
The biggest weekly range ever.
Exactly. It suggests massive internal churning, a huge fight between buyers and sellers. Often that marks a top or is very close to it.
Okay, widest weekly spread. What's next?
Second, a high volume break of the 50-day moving average line. That's pretty definitive.
The 50-day line?
Yeah, it's a key intermediate term trend indicator. If the stock slices below its 50-day moving average and does it on heavy above average volume,
right,
it means the institutions have likely stopped supporting the price at that level. Distribution is underway.
Got it. What if a stock has a massive, really exciting run-up in a single day? Like its best day ever. Is that always a good sign? Buy more.
Surprisingly, often not. Be very wary of the largest daily price run-up.
Really? The best day is a warning.
Often, yes. A stock frequently peaks, or comes very close to its ultimate peak, on the day it registers a larger percentage price increase than any previous up day in its entire current move.
Why?
It's often the blow-off top. The last gasp of buying frenzy, sucking in the final amateurs before the smart money pulls the rug.
Wow. Okay.
Similarly, watch out for the heaviest daily volume day. The day with the absolute highest trading volume often coincides with the ultimate peak.
Especially if something else happens.
Especially if that huge volume day turns into a reversal, meaning the stock trades much higher during the day, but then closes near the low end of its daily range, or even lower than it opened. Huge volume on a reversal day is a major red flag.
High volume turning, basically.
Yeah.
Okay. And finally, what general change in the stock's day-to-day behavior indicates that institutional selling is starting to dominate?
Look for an increase in consecutive down days. If you start seeing, say, 4 or 5 days where the stock closes lower, followed by maybe only a brief 2 or 3 day bounce attempt that fails, and then it rolls over for more consecutive down days, that pattern indicates that sellers are consistently overpowering buyers day after day.
The sellers are winning the daily battle.
Exactly.
Yeah.
This is institutional distribution dominating the trading action, and it is a very clear signal to exit your position, or at least significantly reduce it. Okay, so we've established the market rules, the buy rules, the sell rules, the defensive techniques. Now comes the ultimate challenge.
The internal battle.
The internal battle, the black belt test. We're moving entirely into the internal game now.
Oh.
Discipline and psychology. Because the greatest systems in the world will absolutely fail if the human element, ego, fear, greed intervenes.
And the sources are just unanimous on this, aren't they? The single biggest liability for any investor isn't the market itself.
Nope.
It's their own ego and emotional trading.
Absolutely. 100%. Success, ironically, breeds hubris. And hubris causes investors to ignore the very rules they swore they would follow when they were learning.
It's like Aloha Mike.
Yeah, Aloha Mike described it perfectly. His early success made his ego swell up. It convinced him that the basic 7-8% loss rule was, maybe for beginners, beneath him now.
He thought he knew better than the rule.
He did. So he started letting losses run to 25%, even 40%, because he was so sure the stock had to come back. He was smarter than the market, right?
Right. Famous last words.
Exactly. He only recovered his footing when he finally admitted, humbled himself, and accepted that every single trade, no matter how much research went into it, could be a mistake.
Every trade.
Every trade. And that mistake must be corrected immediately and mechanically by the rule, not by his ego.
That story of hubris is just terrifyingly illustrated by Charles Harris, too. He achieved monumental success, the kind people dream of.
Oh, absolutely.
Only to watch it just evaporate incredibly quickly.
Charles Harris lived the dream for a while. He ran his personal account up a staggering 1,500% in just 18 months.
1,500%?
Yeah, through intense study and initially disciplined application of the rules. But then, when the brief 1998 bear market correction hit...
Just a correction, not even a full bear market.
Right. His hubris, as he called it, caused him to fight the clear downtrend. He was emotionally committed to his winning streak, to his genius status.
Couldn't admit he was wrong.
Couldn't bring himself to sell. And he lost 3/4 of his money in a very, very short period.
3/4 gone. Wow.
The lesson was brutal, but clear. Ego is the absolute death of trading success. It led him to take the extreme measure of actually wiring funds out of his trading account.
Getting the money away from himself.
Exactly, just to physically stop himself from making more emotional trades, more revenge trades, and compounding his already devastating losses. He understood, viscerally, that removing access to the money was the only way for him to break that destructive psychological cycle.
Wow. So if the mind is the enemy here, what are the practical daily strategies people use for maintaining emotional control? Mike Scott, you mentioned, fought the temptation of watching those intraday price swings.
Right.
He found specific techniques that acted like a circuit breaker for his emotions.
Yes, Mike Scott implemented 4 really effective, practical strategies. First, he just stopped watching the 5-minute intraday charts. Cold turkey.
Why? Too much noise.
Pure noise. That minute-by-minute random movement is almost perfectly designed to trigger impulsive fear and greed reactions. It serves no analytical purpose for a position trader.
Okay, no 5-minute charts. Second.
Second, he mandated for himself that he must wait until the end of the trading day to make any decision to buy or sell.
Wait till the close.
Wait till the close. Yeah. This forced, rational, considered decisions based on the full day's action rather than knee-jerk, instantaneous reactions to some midday price spike or dip.
I think that delay mechanism is fascinating. It turns what could be a quick emotional impulse into a planned, almost business-like action.
Precisely. Third, he started using the weekly chart as his primary analysis tool, not the daily.
The weekly chart.
Yeah. This forces a longer-term, zoomed-out perspective. It minimizes the psychological impact of normal daily volatility, the noise within the bigger trend.
Okay. And fourth?
Fourth, and this is key for interrupting that emotional spiral. When he feels the impulse to break a rule or trade emotionally or just stare anxiously at the screen, he physically walks away from the computer.
Just gets up and leaves.
Gets up and leaves. He uses that time away, goes for a walk, a bike ride, maybe does some meditation to regain a grounded, non-emotional state before making any irreversible trading decision. You have to remove yourself from the source of the emotional trigger sometimes.
Walk away. Simple but effective. Okay, so the ultimate preventative measure against the ego getting out of control, though, seems to be the power of the written plan.
Yes.
It dictates that you treat investing not as a hobby, not as a gamble, but as a serious, documented business operation.
That's the entire ethos of mastery, isn't it? And it's exemplified perfectly by Steve Power in the sources. His rigor is just legendary.
What did his routine look like?
His weekend routine was incredibly structured, almost mechanical. Every weekend, create a detailed watch list of 10-30 current leading stocks, filter that down to a highly selective buy list of maybe 1 to 5 actionable candidates for the week ahead. Update all stop-loss orders on a spreadsheet, ensuring none are ever wider than 8%. Review the IBD 50 list for new potential leaders, and update a comprehensive market journal with his thoughts and analysis.
Wow, that sounds like running a small financial institution, not just managing a personal account.
It basically is treating it that way,
Yeah.
and his daily routine was equally disciplined. First thing, read the big picture to confirm the market trend. Check his watch lists and buy lists for any trigger alerts. And meticulously record all trades in his journal, noting the buy point, the reason for the trade based on his plan, and the mandated 7-8% stop loss level.
So the decision is made before the market even opens, usually?
Exactly. This mechanical, step-by-step approach largely removes emotion during the trading day because the core buy-sell decisions were already made rationally, based on his research over the weekend or the prior evening. It wasn't impulsive.
Paramjit Chumber came to the same conclusion, right, after trying other methods.
Yeah, Paramjit had a rough start. He lost significant capital trying various approaches, value investing, options trading, swing trading, without a core methodology. He only turned things around when he adopted a formal, written business plan for his trading and instituted mandatory monthly trade reviews to analyze his performance objectively. He emphasized that without a specific written plan that you are in control of, the market will control you through your emotions.
If the written plan is the daily discipline, then the critical art of post-analysis is how the master evolves, right? How they actually get better over time. You absolutely must learn from your mistakes.
And your successes too. Katrina Gench's method is a fantastic template for this crucial post-analysis process. She maintains a daily journal, just jotting down her thoughts on the market action and the leading stocks she's tracking.
Okay.
But her really intensive post-analysis involves printing out the daily and weekly charts for every single stock she buys or sells.
Printing them out physically.
Physically printing them. Then she annotates them, documenting the fundamentals at the time of the trade and detailing her precise reasons for entry and exit. Then she organizes all these annotated charts annually, sorted by performance winners and losers.
That's incredibly detailed. What's she looking for? What are the key questions this detailed post-analysis is designed to answer, especially for finding those unique personal weaknesses or bad habits?
She focuses on pinpointing the behavioral gaps, the rule breaks. Key questions she asks herself include, did I break any of my written rules on this trade? Did I enter correctly? Was it a proper base breakout with volume, or did I chase it? Did my emotions cause me to sell too soon out of fear, or maybe hold on too long due to greed or hope? And importantly, what percentage of my portfolio was actually invested in the strongest leading stocks within the strongest industry groups at the time?
Checking alignment with the market leaders.
Right. This level of intense scrutiny turns every single trade, whether it was a win or a loss, into a documented, learnable lesson. Deborah Clute, who actually quit her accounting job to trade full-time, summarized this attitude perfectly. She said, "Mistakes equal learning. You must systematically review what went wrong and why to prevent making the same costly errors over and over again."
Mistakes equal learning. I like that. Okay, so this disciplined approach, the plan, the post-analysis, this is what enables those life-changing moments in investing, right? The ability to act with real conviction when it matters most.
Absolutely. The ability to act decisively, without hesitation, comes from deeply trusting the system's rules over your own gut feelings or fears in the moment. Mike Hicks's Taser story is just the ultimate illustration of this rule-based conviction crystallizing into a life-changing action.
Tell us about Mike Hicks and Taser.
Mike was a frustrated CPA. He used to lose money doing what many amateurs do, buying cheap, low-priced stocks, hoping they'd turn around. Then he discovered and rigorously adopted the Can Slim system. He bought Taser back then, based on its strong fundamentals and chart. He watched it run up significantly.
Okay.
Then, in a pivotal, truly life-changing moment for him, he was listening to an analyst call or presentation, and the analyst happened to mention that Taser was planning excessive stock splits.
Stock splits, why is that bad?
Multiple rapid stock splits are often a key technical warning sign. It can indicate that a company's management is maybe getting overly promotional, or that the stock's big run is nearing an end. It's one of O'Neill's classic topping signals.
Okay, so Hicks recognized this signal.
He recognized it immediately from his studies, and he didn't hesitate. His prior analytical work on the stock, combined with recognizing this technical warning sign, gave him the conviction to act instantly.
What did he do?
He immediately called his broker and sold his entire Taser position, locked in a massive 294% gain.
294%. Wow. Why was that specific moment life-changing, though, beyond the huge profit?
Because just days later, Taser released disappointing earnings. The stock absolutely cratered, falling 29% in a single day.
Oh, my goodness. He dodged a bullet.
A huge bullet. His single rule-based decision, recognizing the topping signal and acting immediately, not only secured him a nearly triple-digit return, but more importantly, saved him from a devastating correction. It proves to him beyond any doubt that the system and its rules were superior to his personal judgment or hope. That's life-changing conviction.
That conviction, though, it must stem from more than just the daily chart line wiggling up and down, right? Especially to hold through volatility. You need belief in the underlying company or product, too.
Oh, absolutely. Ed Hornstein, another successful investor in the sources, notes that conviction is absolutely key to holding those big winners through the inevitable 20%, sometimes even 25% pullbacks that occur during major uptrends.
Because those pullbacks feel scary in real time.
They feel terrifying. The only way you can sit tight and not panic sell during those sharp drops is if you truly understand why the company is likely to be successful in the longer term. It must possess a truly revolutionary product or service, something game-changing. If you're only relying on the chart pattern, that volatility will shake you out. You need the underlying belief in the long-term story, reinforced by the short-term technicals, to give you the strength to sit on your hands during those scary but normal corrections.
It's the why behind the buy.
Precisely.
And what's the ultimate reward for all this incredible discipline? The planning, the rule following, the emotional control. It seems like it moves beyond just dollars and cents in the account for some people.
It really does. For disciplined investors like Barbara James, who shared her story, consistently following the rules, taking most profits methodically around 20–25%, cutting every single loss at 7–8% without fail, translated directly into financial freedom.
What did that look like for her?
Her success from investing this way allows her to fund annual, month-long trips to exotic locations all across the globe. She mentioned India, Africa, Australia.
Wow.
Her story beautifully demonstrates that mastering this system isn't just about numbers. It yields tangible freedom. It allows you to live the life you want, supported by a predictable, rule-driven system for growing your capital. It's about funding your life goals.
All right, we arrive now at the pinnacle, the highest level of mastery. We're synthesizing the ultimate lessons from the original teacher himself, Grandmaster William J. O'Neill.
Yeah, Bill O'Neill.
We're talking about the man who didn't just follow market rules, he essentially identified the core behaviors of the market itself through decades of analysis.
That's exactly right. Bill O'Neill's genius really lay in his unwavering dedication to intensive, objective historical research. The can slim methodology wasn't just born from his opinion or gut feel.
No.
No, it was painstakingly born from analyzing every single one of the greatest stock market winners going back to the turn of the 20th century through the 1950s and beyond.
Analyzing the biggest winners after the fact.
Yes, to find the common shared fundamental and technical traits they all exhibited before their huge exponential price runs began. What did they look like before everyone knew they were great?
Finding the pattern before the payoff.
Exactly. And his personal success using this was immense. He famously bought a seat on the New York Stock Exchange at age 30, the youngest person to do so at that time.
Wow.
But I think his enduring legacy, really, is his commitment to empowering the individual investor. That's why he launched Investors Business Daily, IBD, back in 1984.
IBD, right?
His goal was to democratize access to the kind of institutional quality data and analysis that previously only Wall Street professionals had, to level the playing field.
Okay, and one of the most critical philosophical lessons that comes directly from O'Neill, echoed by everyone who worked with him, is that ultimate long-term success relies on flexibility over ego.
Yes.
This goes right back to our earlier black belt discussion about ego, but maybe at an even higher, more strategic level.
This is truly the mark of a Grandmaster investor. Bill O'Neill is legendary because he's just not stubborn. He feels absolutely no need to be right about his market forecast. He only cares about being aligned with the market's current reality.
Can you give an example of that flexibility in action?
Yeah, a perfect historical example is the late 1990s tech bubble.
Yeah.
He was actually decidedly bearish through much of 1999. He correctly saw the speculation and predicted the bubble would eventually burst.
So he was bearish.
He was bearish in his outlook. However, in September 1999, the market flashed a clear, confirmed follow-through day signal, an FTD.
The signal to buy, even though he thought the market was too high.
Exactly. What was his response to that hard, objective signal, given his own deep-seated bearish view?
What did he do?
He totally changed his mind, as one portfolio manager described it. He instantly accepted what the trend was telling him.
Just flipped completely.
Completely flipped. He immediately put aside his personal belief that the market was fundamentally overvalued and focused solely on the message coming from the price and volume action of the indexes and leading stocks.
Wow.
He moved quickly to capitalize on the final explosive blow-off run of that bull market. The moment the market's evidence shifted, the true master shifted with it. It demonstrates profound flexibility and respect for the market's facts, rather than clinging stubbornly to a preconceived notion or prediction. He lives in the reality of what the chart tells him now.
That philosophy, that flexibility, it must be deeply instilled in his professional organization, too. How does this Grandmaster wisdom translate to actually investing like a portfolio manager at O'Neill's firm? What do they emphasize?
Scott O'Neill, Bill's son, who helps run the firm, stresses that for long-term survival and success in the markets, you absolutely require a dominating defense that's even stronger than your offense.
A dominating defense, more important than picking winners.
In the long run, yes. Scott says almost anyone can pick a winning stock in a powerful bull market. That's the easy part. The true masters, the ones who last decades, are the ones who excel at preserving capital during the inevitable bear markets and corrections.
Defense wins championships, as they say.
Exactly. The robust set of sell rules, that mandatory 7-8% loss rule, the strict adherence to market topping signals like distribution days, that is the core defense.
Can you give us a concrete example of how this dominating defense saved professional money in this firm?
Absolutely. It's reported that every single portfolio manager at O'Neill's firm successfully exited the market, moved largely or entirely to cash, well ahead of the devastating 2008 global financial crash.
They got out before the crash. How?
They did it simply by objectively observing the clear mounting institutional selling signals, the increasing number of distribution days on the major market indexes throughout 2007 and early 2008. They heeded the market's warnings.
So they sat in cash while everything collapsed?
They sat safely in cash as the S&P 500 proceeded to fall more than 50%. It's a powerful demonstration that recognizing when the overall market tide is turning is far more critical to long-term survival than trying to chase the last 5% or 10% of a dying bull run. Preserve capital first.
Okay, defense first. And once a winner is found in a healthy market, the second big lesson seems to be the importance of patience. You need the endurance of a grandmaster to hold on.
Yes, patience is crucial. But it's informed patience. Jim Roppel, who's a top trader following these principles, notes that the truly big leaders, the stocks that generate life-changing wealth, take time to unfold.
How much time?
Typically 12 to 18 months, sometimes even longer, to make their truly monster moves.
A year to a year and a half or more.
Right, and this requires immense psychological fortitude because during that time, you will have to sit through intermediate corrections within that overall uptrend. These pullbacks can often be 20%, sometimes even 25%.
25% down on a winning stock. That would scare most people out.
It shakes out 90% of amateur traders. The only way to psychologically survive those sharp, scary drops and capture the subsequent rebound and continuation higher is to have that deep conviction we discussed earlier.
Back to conviction.
It has to be born from your initial deep research, your understanding of the new factor, your belief in the company's product or service. Without that fundamental conviction, the volatility will force you out too early.
Okay. And this journey to mastery, it's clearly never really complete, is it? Mike Webster emphasizes that this is a process of continuous study, constantly learning, which really reflects Bill O'Neill's own relentless work ethic.
Absolutely. Mike notes that Bill, even well into his later years, was still looking at hundreds, maybe thousands of stock charts every single weekend.
Every weekend, wow.
Constantly hunting for new ideas, new patterns emerging, new potential leaders. And Mike and his team follow that same rigorous example. This continuous study, this immersion in charts.
What does it do for you?
It allows you to internalize the patterns. You start to see that while the company names change, the specific industries change. The chart patterns of success are timeless. They repeat over and over again.
Patterns repeat across decades.
Even centuries. Mike famously compared the historical chart pattern of Tennessee Coal and Iron from way back in 1898 to the chart of Apple in 2004.
100 years apart.
Over a century apart. Different industries, different eras. But the technical geometry of their massive price bases and the nature of their powerful breakouts were virtually identical. Only the names fade. The underlying structure of accumulation and breakout is eternal. Human psychology reflected in charts doesn't change much.
That's fascinating. And this systematic approach, looking for these patterns and fundamental markers, it's been formalized into accessible tools that individual investors can use now, right, to speed up the process.
Yes, exactly. They leverage data and technology to make the routine faster and more efficient. They created tools like the IBD composite rating.
The composite rating, right.
It synthesizes dozens of key technical and fundamental characteristics into a single score, from 1 to 99. It quickly helps you identify overall stock strength relative to the entire market. Saves a ton of initial screening time.
Okay.
They also developed screening tools like the MarketSmith Growth 250 screen. This pre-filters the entire market down to roughly 250 high-quality growth stocks that already meet top technical and fundamental criteria. It effectively does hours, maybe even days, of initial screening homework for the user.
Helps you focus on the best candidates quickly.
Precisely. Mike also highly recommends practicing pattern recognition using tools like the free chart arcade feature on MarketSmith. It lets users basically trade historical charts. You see a chart develop, you decide to buy or sell, and you get immediate feedback on whether it worked. It rapidly accelerates the learning curve for recognizing bases and breakouts through repetition, but without risking real money.
Practice makes perfect, even with charts. Okay, let's try to consolidate all this Grandmaster wisdom into the final master lessons from the collective experience of O'Neill and his top students. What are the absolute core takeaways?
Well, Kevin Marder, after interviewing dozens and dozens of top traders for his books, found that the absolute key was learning to truly listen to the market's message and completely eliminate your personal opinions and biases.
Listen to the market, not yourself.
Exactly. He often quotes O'Neill's blunt assessment. The market doesn't know who you are, doesn't know how bright you are. It simply doesn't care. Your ego, your predictions, your hopes, they're totally irrelevant. Only the price and volume action on the chart matters as your guide.
And the market's messages, they aren't just random noise, right? They are fundamentally repeatable patterns.
Jerry Samet's big lesson. Winning stocks repeat similar behaviors. The patterns recur. He learned this powerfully when he bought Collagic after it had already tripled in price.
Bought it after a triple. That sounds late.
It sounds late, but he noticed its specific chart behavior, the way it based and broke out again, was identical to an earlier monster winner he'd had, a stock called ECI Telecommunications. He recognized the recurring pattern of strength.
So big winners can give you multiple chances.
Often, yes. Big winners frequently pause, consolidate, form another base structure, and then give the disciplined, observant investor a second or even third opportunity to get on board if they're diligently watching the leaders and recognize the pattern repeating.
Okay. And finally, K. Basu distills this entire complex system down into just two highly actionable, almost deceptively simple actions for the average investor.
Yeah, his synthesized advice for achieving consistent results is remarkably succinct and powerful. First, wait for a confirmed follow-through day, FTD, after correction, and then, crucially, scale in slowly. Don't jump in with your whole position at once. Test the waters first to see if the market is truly accepting the new uptrend.
Okay, FTD, then scale in. What's the second thing?
Second, take most of your profit systematically at 20% to 25%. Don't get greedy trying to hit home runs on every trade.
Back to the profit rule.
Back to the core profit rule. Basu suggests that if you consistently do just those two things, wait for the FTD to enter, and take profits around 20-25% in a reasonably decent market environment, you can realistically aim for 25% to 50% yearly returns over time.
Wow, just from those two core rules.
He also adds a useful tip. Watch the IBD 50 list during market corrections. If the top 10 stocks on that list are successfully holding key support levels and starting to set up new tight bases while the market is still correcting, that's a powerful leading indicator of overall market health and tells you where the future leadership is likely to come from when the uptrend resumes.
So the ultimate wisdom then really is that this sophisticated system works wonders, but only if you commit to actually working the system consistently day in and day out. That's the bottom line. Discipline equals freedom, eventually. Hashtag outro. So we have really completed quite a journey today, haven't we? Moving from those essential white belt foundations, understanding market trend via the FTD, learning the core can slim criteria,
Right.
through the absolutely crucial defensive measures of breaking boards, that mandatory 7% to 8% loss rule, the statistically proven 20% to 25% profit target, and finally, really internalizing that black belt psychology. What it takes to conquer ego, manage fear, and maintain a rigorous business-like routine for your investing.
Yeah, the path to investing mastery, it's clear, is paved with continuous education and just relentless discipline. There are no shortcuts around the work.
Not at all.
The professional investors we studied today, they prove that if you prioritize managing risk first, if you build that dominating defense, as Scott O'Neill called it, the capital preservation will ensure that the profits ultimately take care of themselves over the long run.
Well said. And Bill O'Neill himself leaves us with this powerful and, I think, really optimistic reminder. He said, "The opportunities are there for anyone willing to put in the work. Somebody will always come along with a different and better way of doing things, and every new bull market will have a Google or an Apple.
The next giants are always out there.
They're always out there, waiting to be discovered by those doing the homework."
Okay, so we've seen the kind of life-changing success that can come from systematic study and unwavering discipline. The next big market leaders, they are likely already emerging, maybe quietly forming their first and second stage bases right now, even as we speak.
They are.
So the question we want to leave you with today is this. Are you doing the necessary daily homework required to spot them? And maybe even more importantly, do you have the psychological discipline practiced and ready to cut every single loss small and then hold on tight for that potential monster run when you find it?